Hello, friends and traders. Welcome to Trend and Sutra. My name is Amit. Merry Christmas to all of you and your dear ones, and a very happy New Year in advance to you and your family. So, this is our special podcast where we are covering gold outlook for 2023. We have taken extract from the report, which is actually published by World Gold Council on 8th of December, which usually and regularly publish its report on gold demand and supply and other parameters. So, despite we have a very dull kind of a performance in 2022, now we are expecting that the upcoming year could be very excited and full of events unfolding in the coming year. So, let's have a look on the report. Gold Global Outlook 2023. So, in 2023 global report, what World Gold Council is saying that global economy at a crossroad, in a crossroad. So global economy is currently at an inflection point where it is being hit by various shocks over the past year, and the biggest was the central bank interest rate hike, which is backed by the aggressive fight against inflation. So, from the word of transitory, the concern now shifted towards a fight against inflation. Going forward, what we are expecting that inflation and central bank intervention will likely be determine the outlook for 2023 and gold's performance. Some few key parameters that is highlighting in the report is like with the headwinds and tailwinds for the gold. And the key takeaways are a mild recession and weaker earning have historically been gold positive. Further weakening of the dollar as inflation decides could provide support for gold. Geopolitical flare-up should continue to make gold a valuable tail risk hedge. Chinese economic growth should improve next year, boosting consumer gold demand. Long-term bond yields are likely to remain high, but at levels that have not hampered gold historically. Pressure on commodities due to a slowing economy is likely to provide headwinds to gold in H1. These are the extracts of report published by World Gold Council on 8th of December. So, if we see in the chart wise, a consensus scenario of a mild recession with greater upside potential for gold than downside. So, if the opportunity cost severe, as you can see in the chart, if there is a severe downtrend in the economy, then it is quite a significant upside is expected in the gold prices, where dollar will be, seen as a safe haven bid, but bond yields will be lower and severe downturn and stagflation kind of a possibility is likely to if it has happened, then the gold prices will shoot up quite higher. In the mild recession with a Fed fund rate of maximum 5%, year end 4.6, slightly higher bond yield, weaker US dollar, mild recession, inflation comes to half, then we have a stable gold outlook with a upside expectation. Well, if we have a soft landing, now what we are when we are talking about soft landing, we all know what we are talking about. Soft landing is like the inflation will recede quite faster, the economy does not hit very much, and the job market does not hit very much, housing market does not hit very much, and other earning of the companies does not hit very much, and that could be considered as a soft landing. So if we have a soft landing in the economy globally, then definitely the pressure will be on the downside in the gold. So we could be positive to neutral to negative in the implication for the gold based on the kind of a implication going to happen in the economy. Historically, as we understand that gold does well in recession, as the chart suggests, if the recession is likely to happen, then it is likely to hit the earning S&P current E earning to ratio is approximately 18.8. And since 1969, the average duration recession has been at 13.6. So considering we have a P in the first half around 16 or something like that, and we were falling earnings that could lead, stock prices correction, that is typically very good for gold in any scenario, like in a scenario and environment when the rising pressure is there on the stock price of corporate earning and the stock prices go down, so it is good for gold. So that's what we are understanding, that any recession is likely to hammer running is positive for the gold. Current rate levels not a threat to gold. So if I'm talking about tips like the bond yield, the 10-year bond yield, the 10-year tips bond yield of US is currently at 1.2%, which is quite fair and is not a threat to uh, my gold prices. So that is what I am expecting. That is what the report is suggesting. Global contraction appear all but guaranteed. So manufacturing service PMI are probably heading for a recession. So these are the studies and parameters which is figured out by World Gold Council and published, which is suggesting that these factors will be likely to heading for a probability of recession. That doesn't mean that recession will come, but these are the expectation for the upcoming year. So it's also calculate the geopolitical threat, which is still quite high. As we can see, it actually peaked around 2022 mid when the Russia-Ukraine war happened. But again, it is slowly coming back to its per range. What we are now understanding, and we are seeing the data in last 2 months from coming from the PCE or both CPI, that for inflation is almost peaking out. But we definitely cannot say on the policy part, because this report was published before the Fed event, before the Fed policy event on 15th of December. So policy, we do not believe that policy is peaked, but yeah, inflation is peaked almost, and it could be expected that in the longer run, then inflation is peaking out, and policy rate could be peaking out most probably, as we are expecting, around by the end of February or by the March. That is what we are expecting with the policy rate hike. Employment and housing showing some strain, which is again indicating for a not a soft landing and mild kind of a recession in the economy, especially in the US economy. GDP is again not indicating any soft landing going ahead, which is indicating in this chart. Uh, Now, whenever we have a recession kind of something happens, always a commodity supply. We have seen there is a strong and constant commodity supply that we have seen in oil and across the commodity. Like in last 20-25 years, we have seen how the supply constant happen, and the prices after getting bottom out then spike up very sharply, whether it's in base metal, oil, or any commodity. So this is very likely that tight supplies may happen into gold, and this is a quite positive in the longer run. Always stagflation favor gold. So what is stagflation? Like we have a inflation, we have a degrowth in the economy, and the policy rates also high. So these are a few of the things which favors, which led to stagflation, and stagflation always favors gold, as we see that gold returns before combination of growth and inflation. So in the stagflation, always we have a higher return of gold in the process. So this is the kind of a return we are seeing in the gold. Now market is almost pricing a cut in 2023. That is what the market is expecting, but we may not be sure on that part, because so far they stand by the Fed, Euro, ECB, and Bank of Japan. Bank of England is very aggressive, and they still remain hawkish at least for 2023. So this may or may not happen. In any case, since the prices always take the position of upcoming time, so we may expect that this may shift it toward end of the 2023. Now, considering that if DI like dollar index is peak, and if DI and dollar index is real real effective exchange rate is currently at 142. So considering that if it is peaking out, and we can see the return of gold after the dollar index has peaked out. So if dollar index peaked out, we have seen a return of 30-35% approximately in 2012, 2005. So if dollar index is peaking out as per the recalculation, then at least 10 to 15% of return is quite moderate in the next one to at least in 1 year. In the next 1 to 2 year, we could see approximately 20-25% of return based on this calculation and understanding. If we consider like spot gold prices, inflation adjusted versus actual prices, so inflation adjusted prices, quite higher compared to what the actual prices are there. So, in that sense, gold is undervalued if we are adjusting itself with the inflation. So, this is again indicating that gold prices are undervalued so far, even at this point of time at this scale. This historical chart, which is inflation adjusted 19 based on the 1915 inflation thing, which is as you can see the peak of 1980. Then in 1980 the spot gold prices touched approximately 800. After that it fell to around 200, right? Around 1998 or 1999 when the chancellor of Bank of England sold gold actually. That was the bottom. So that was the bottom. But again, like this was the inflation adjusted stock which made in 1980, and these are the two tops which we made around 2010, 2011, and then in 2020 after the COVID peak, COVID happened. Now, the upward range coming year could be higher. That is also suggesting that if you consider all these factors, the prices are likely to go higher. So these are few understanding from the World Gold Council, which is suggesting that this is the actual scenario and actual expectation on the gold prices. So if we study something on the technical part, technically gold is to see the setup in the market. After 2009, like after 2008, 2009 crisis, gold gave a absolute run of 57%. It rose by $600 approximately and peaked around 2011. We see very consolidation between this reason in the since 2011 and again till 2020, and then gold rebounded again around this level like 1800 and find a support. It does not break $1600. That's the main point. So considering if gold is breaking and sustaining above 1800 or $1830 in the coming time, then the next possible approach, what we are expecting with a 25% return is approximately $2600. So there is a expectation of at least 600 to $700 of further spike in the gold prices. That could be the breakout. That if the breakout happens, the next ideal target on the upside could be around 2600 in a very conservative manner. Because when the last time the rally happened, and from 2006 onward, the gold prices moved from $600 to approximately $1200. So that was almost double. But after the consolidation, the gold prices spiked from $1200 to $1925, so approximately $700, and in real terms, 57%. So even considering we are, even half of the rally, if we expect in percentage term, so that comes around $2600 that we are expecting on the upside. If we talk about gold in MCX or domestic prices, then due to the INR depreciation, in this reason, from 2019 or till 2020, when the spike was happened in spot gold prices also, and the spike was into dollar rupee also. So we have a approximately 30% of spike that we can say that gold prices gone up. Now, if we are if the gold prices again break this high of 55,556,000, then the breakout could lead for at least 15% of spike and approximately around 61,700 or 61,500. That could be the working target by the year end that we are expecting, especially into the MCX code. Stay with us. We are likely to, give you more insight by the end of this video. So, gold not only, performed quite flattish in this calendar year, but why it performed quite flattish in this calendar year and after 2020 is one of the reasons was also the investment which actually diverted, the institutional investment which actually diverted into cryptocurrency, and the way cryptocurrency has moved up sharply and then fell sharply, and all this nuisance and all the noise which happened in past 6 months and a year and so. So gold usually, and whenever the inflation is there, despite we have a higher inflation, gold couldn't perform well because of the alternative investment sources like cryptocurrency was quite lucrative and attractive for the institutional money, and they put it their money into uh, Bitcoin and other cryptocurrencies rather than to gold. So if you look, the kind of a return and the kind of a performance gold is sharing with the Bitcoin. So if you see that thing, it's since the inception of the Bitcoin, the return in Bitcoin is quite higher compared to gold. But in the last 5 years, if we see, gold has performed well against the Bitcoin. Gold has given an absolute return of 43%, whereas the Bitcoin has given a return of 19.69%. So this is all the news and spikes what we have witnessed into the Bitcoin, which is where it is given 360% of return. But in the last 1 year, if you see, gold is in fact almost flat, like minus 0.32%, and still we have a few more session left for the year. But Bitcoin has crashed by more than 66%. So the currency, the alternative, what market was selling as a product is now finally settled down and almost dusted down. So in coming year, we're not expecting very much action is likely to happen on the Bitcoin and all the cryptocurrency upside, and gold will likely to get benefit from these factors. And going ahead, we can expect that the gold will attract more institutional money rather than the cryptocurrency. Gold is more stable compared to any asset class, and especially against cryptocurrency. So the money which was actually flowing into the cryptocurrency and all this speculative money is now we are expecting to come and go into gold prices, considering all the factors and fundamentals are now favoring gold prices. If we see, the central bank remain a very key player in the global gold market, and central bank maintain their appetite for gold. Interestingly, global central bank gold reserves are now back to 1970 level. So this is very significant that not even in 2011 really this reserves were so high. In fact, we can see that after that 2011, 2008 crisis, 2000 to 2011 peak, the reserves are continuously increasing, and which is now back to 1917 level, which was basically a year when dollar was decoupled from the gold. Year to date, central bank net purchase and sale, Turkey remain the net biggest buyer, official biggest buyer. Egypt, Uzbekistan, Iraq, India, Qatar, UAE, and these are a few of the central banks who are actually having cash, and they are buying quite aggressively. We are yet to find any substantial bank from the China, or the data is not yet shared by the Chinese central bank, so we cannot consider on that part. In the quarter 3 2020, central bank almost for 400 ton of gold, which is quite impressive. This is just to understand like how spot gold prices has performed in last 5 years in different currencies. So if you see in Indian rupees, it has given a return of 82% compared to what is given return in US dollar, whereas in yen it has given a return of 65% compared to 41%. In British pound, gold has given a return of 56% compared to 41%, and euro has given a return of gold and euro has given return of 57%. Same with the Russian ruble and same with the yuan. So yuan is only the currency where it has given a least return compared to all other currency because technically dollar has weakened against euro, GBP. Uh, um, Technically dollar has become stronger against GBP, euro, INR, ruble, and other currencies, which is actually factoring in the price because the gold in the domestic currency, let's say in Indian rupees, we have the highest one because rupee has depreciated by more than 40% last 5 years. You know, not more than 40%, more than 27%, 28% in last 5 years. So the effective returns in rupee is quite higher than the effective returns in dollar. Considering all these factors, what is suggesting now that gold is, going ahead quite positive. But there are few feedback, few drawbacks also that we always need to understand and consider. So we have a higher inflation going ahead. The geopolitical risk will be higher, but the inflation is also higher. We have a spike in oil prices because of certain issues, and there is a global commodity, bottleneck, especially into agri commodity, and that will lead to further higher inflation rate. That will, withhold the central banks to further easing any kind of monetary policy, and that could be quite positive for the dollar, and that is a negative for the gold prices on longer run. Despite inflation is hedge against, gold is considered as a hedge against inflation, but in this current scenario, the purchasing power of the people will decrease and the consumption of the retail gold will decrease. So that is a very normal basic phenomenon in the economy. And if the COVID, if the COVID and concern and everything, goes beyond what we are, hearing currently from the China, and if it is spread along the globally, then probably we could have a negative impact, net negative impact in the gold prices. Gold prices could spike up, but effectively the gold prices will come down if these problems, escalate to a certain level, what we have seen in 2020. There are a few other factors like the equity outperformed or well performed in 2023 because of the liquidity, which is not, transferring, shifting towards cryptocurrency and it has shifted to stocks, then probably that could be the headwind for the gold prices. Otherwise, factors, data, technically, we are expecting some breakout and everything. So all these are indicating that positively the gold prices going ahead in 2023 and forward, the price is looking quite positive. Even with the inflation interest rates, the actual prices are undervalued. Now the biggest question comes like if the prices, if we are expecting the, the prices are going upward and ahead, then what are the avenues and how we can get benefit out of it? So in India, if you see, we have a few gold investment options available. You can either invest through digital gold. So digital gold is nothing, you can buy a minimum of 1 gram of gold. There are many platforms like Tanishq and BC. The banks are also providing, almost every banks are providing fintech application like, Paytm, PhonePe, they are also offering gold prices. The price of that 1 gram gold is always quite high compared to the market prices. So that, and there are other charges also. Uh, the another way to invest in gold is in gold through gold ETF. Most popular ETF is gold lease. So you can simply, buy it in your demat account, and you can open a demat account with us also. The description is in the link. And with any of your demat account, if you have a demat account, you can simply buy gold lease. It's a unit, like you are putting your money into Nifty Bs. You can put your money into gold Bs, whatever the value of the gold Bs at that time. You can buy that 1 unit of gold Bs, and accordingly you can invest that much of amount, and that will be holding in your TP account and convert into your demat account. It is like a digital gold where the return absolutely comes into, like the return will exactly mirror the gold returns in INR rupees. The most interesting way to invest in gold right now is sovereign gold. So these are bonds which are actually periodically released by Reserve Bank of India. Only 2 days back on 23rd, the last scheme mandate, where the price was quite low at 5,400. In this bond, you will actually not buying a physical gold, but the paper bond having an underlying asset value of gold. So government will pay you 2.5% interest rate yearly, which is paid semi-annually in your bank accounts. Whereas the holding of this paper is tenure is 8 years, and you can exit after 5 years along with your interest. So after 8 years, let's say the gold prices is 70,000. So you will be getting your money based on that price. And if it comes, if it is, around 40,000, then the risk of the price is yours. Government will only pay you 2.5% interest assured on your investment. You can put minimum of 1 gram to maximum of 4 kilogram for any individual. So these are like, these are very long-term investment. Gold are quite liquid. You can buy and you can sell, just like any stocks. But sovereign gold bonds, as I suggested you, that it is, the holding period is of minimum 5 years and maturity is of 8 years. One of the other method you can, invest in gold market, or you can trade in gold market, is through M6 Bulldex. So M6 Bulldex is a bullion index which is offered and traded in M6, just like Nifty. So Nifty, we have a 15 Nifty stocks. Bulldex is a bullion index, which can be traded with a 5% of span margin plus minus 2% additional whenever, exchange to it. It's available in a monthly cash settlement expiry. So you do not need to worry about any delivery kind of a problem. You will buy it and it will settle. If you have not squared it of the position, then it will be settled in a cash at the end of the month or at the end of the expiry date. So the weight of this in current year is 63.7% of gold and 36.3% of silver. So effectively, by investing or trading into the Bulldex, you will get benefits of both gold and silver up and down. Weights are all anyway rebalanced annually during January period. So upcoming 2023, we will see how much gold is weighing and how much silver is weighing. So you can check it through your MCX website. Thank you for watching. Follow us on Twitter, Telegram. You can mail us. Kindly like this video, share, and subscribe to our channel. A part of that, this is just a summary of the gold outlook. Uh, we will try to publish it in Hindi also, so you can check that thing. Thank you for your time and patience. You have a nice New Year. Thank you.